Thank you again for joining us. I'm Marlin Bohling, your tour guide to the ag commodities, and I'm joined in studio by Chris Swift. He's with Swift Trading, and he's based in Nashville. How you doing?
I'm doing great. Good morning. Welcome back.
Yeah, well, thank you. Good to be back. Good to be above ground, as they say. All right, let's talk about this market action we have seen here so far. We'll start with the corn market and our quotes provided by bar chart here. Then we'll just kind of walk through these here. So we're still higher in the corn, Chris. We have December 3.5 higher at 548 3/4. We're higher, but we're off of our high of the day by a little bit here. Now, if you look at the soybeans have been chopping around. They were higher early last night, then they went fairly sharply lower. And now you have November soybeans 4 3/4 lower at 1344 1/4. Now 5 lower. But this wheat market is a whole different story today. And again, we'll take a look at Chicago wheat. How about this? 17 higher on September at 720 3/4 per bushel. And excuse me, in Kansas City, September 19.5 higher, Chris, 692 3/4. You know, it got within a penny of $7, so it got really strong early this morning. Minneapolis is trying to keep up, but it's up 10.5 at 915 1/4. How do you read the tea leaves here? Wheat leading the way by far, but is this a one-day wonder or what?
Well, wheat's been making headway for probably the last 2 or 3 days, and a lot of it has to do with the shared weather that we have with Canada and the U.S. and in that drought area that we have with that is impacting their wheat as it is our Minneapolis spring wheat. So we look at that and beans, and in those areas we've got some still filling out of pods in the beans left, so they could use some rain up there. And pollination is pretty much over with in corn. There'll be a few more spots out there to still be pollinated, but other than that, we're kind of wrapping up the end of the crop year here pretty quick.
Now the wheat tour, the spring wheat tour, wrapped up, and as expected, it's going to be a pretty poor crop out there. But I did want to show you the dollar value. Let's take a look at the dollar index. Have you seen this morning? It's down 223 points at 91.965 on September futures. That has to be somewhat supportive overall to the ag trade, especially in the grain markets, you would think. But what is it that's weighing on the dollar right now?
You know, I'm not real sure, but we noticed last week with the GDP numbers that came out and the FOMC meeting minutes when they were released, we saw the markets kind of move higher, as in if they were going to continue with the liquidity flows. And we know that interest rates have been dropping, and we noticed last week that when adjusted for inflation, we're seeing some of the lowest interest rates that we've seen so far.
So when you go back and you look at, let's look at the corn prices, and let's look at the relationship between September at 549, December at 549. Then you get into the spring months and you have them a little over $5.50. But generally you get to this time of year, and don't you starting to see the basis kind of erode a little bit as you get toward harvest?
In the basis you do. Here what we're looking at is spreads for carry. So in the back end of it there, we start to see we're going to try to attract a little bit more grain down the road. We've been saying we want it right now, therefore achieving the highest price for corn right here at the moment. I have to have it. Now they're saying, you know what, we'll make the back end a little bit higher and try to attract some of that corn and put it on storage so we'll have more for the latter part of the year.
That's what I was wondering about. Okay, stay put. We're going to come back and we'll talk more with Chris Swift. We'll take a look at our livestock trade when we come back. We're back with Chris Swift. Let's take a look at our livestock trade this morning here on a Monday, and we are now mixed here, Chris. Earlier we were higher across the board. You have October live cattle down a dime at 127.10. You have December up a dime at 132.75. When you look at this live cattle trade, Chris, are you focusing on the October contract most right now?
I am, because August is pretty much in theory in delivery, and we've already taken care of the kill slots for those cattle that will be slaughtered in the month of August. So, yeah, October carrying a little bit of a premium, and cash mixed, a little bit lighter in the south, a little bit heavier in the north, and the difference between the two comes in right at about 121, 122 for cattle. And, you know, with the August at 122, there's not a lot there, but with a $5 premium on the October, that's what we want to try to look at.
Now, let's bring those prices back up again if we could. And on the deferred contracts, now they're showing more strength. And like you said, they're already at a premium to the nearbys. For example, look at February, 137, and October is only 127. What is that telling you then when you have another $0.50 gain in that spread today?
Probably be placing fewer cattle going into the fall of the year. And that's what we've seen. We've seen 2 months in a row now of lower placements. With the semi-annual cattle inventory report having came out last week, it showed us that we are not going to have quite as many feeder steers to work with this year going forward. So the calculation turned out to be about 500,000 head is what it turned out to be. So we can assume a little bit lighter placement going through the fall. We've already been through a lot of the hot, dry weather, and a lot of cattle that were going to move have already moved, and the likelihood of seeing any kind of really big movements from here is not as good as what it has been.
Now that October chart that we just had on the screen, does that look to you like it is just maintaining an upward trending channel?
You know, it's got a good upward bias to it. We've noticed that open interest has fluctuated a little bit back and forth, but we're teetering around that 400,000 level for open interest. And I think you've got some real interest in this market, considering that we are probably going to place fewer cattle going forward. We have great consumer demand on hand right now, and our biggest probably hiccup is just what the retail price is at the grocery store. So if we could ever start to get the grocery price down just a little bit, I think that consumer would come right back in again a little bit heavier for beef consumption.
Well, let's look at feeders, and with the market action that we have seen here in the corn market this morning, it's interesting where the feeders are over $0.50 higher all across the board. September up 55 at 162.35. Are you encouraged by that?
Always. These were new contract highs last week made in some of the feeder cattle market, and still being able to carry a $10 to $12 premium going into the fall is a pretty hefty premium for the futures.
All right, and you can see on the chart there, they had a big nosedive back in May, but it's been somewhat constructive, of course, ever since then. Now, if you look at our lean hog trade right now, you currently have the October contract 85 higher at 88.87, kind of in the middle of its trading range here today. Do you consider that a win?
Well, it always is anytime prices are higher, but it's kind of interesting. We saw huge volatility last week when the ASF was announced in the Dominican Republic, and I'm not real sure that anybody knew what to do with that information, so they've traded it back and forth several different times, and now we're kind of planing out with a little bit more to the upside, and the lean hog index has been able to hold its own for the last couple of weeks as well.
All right. It's been a very volatile market, that's for sure,
is.
to say the least. Thank you for coming in.
Absolutely. Always a pleasure.
Chris Swift of Swift Trading. Janet, I'll turn it back to you.